equity loan. So this is a lump sum loan. It is dispersed when, like, whenever you set the loan up, like say you take 50,000, 70,000, 100,000, you're gonna get that amount. That lump sum is gonna come right into your bank account. Okay, that'd be nice if that happened to me. Anyway, this is best for one-time expenses like home renovations, debt consolidation. It just depends on what you want to use your equity for. Okay, I went over that in the last video, but I've seen many uses for products. Kitchen remodel, depending if not fixed principal and interest payments. This is the way to go. So this is stability, and what I mean by that is your payment is automatically going to go to principal and interest. So when you take a home equity loan, typically every lender is different and they work differently. But typically the payment works off an amortization schedule here as well. So just like a mortgage would, you're paying your principal and your interest down within like 10, 20, or 30-year period, whatever your term is. Term is just simply how long you're taking the loan for, and it's calculated, and you should know those options whenever you're looking at a solution, if you want to pay your principal and your interest down right away. Okay, but a home equity line of credit is a little different. So this is like a credit card attached to your home. So think of it like that. It's a revolving line of credit. Okay, can be ideal to some people. Others, you know, just depends on your financial situation, convenience, what you're really looking to do. Okay, so as I had mentioned, the home equity loan, that one does a lump sum. You have a fixed payment back. That's pretty much simple and sweet. Home equity line of credit is basically you have this line of credit out there, 100,000 we'll just say, and when you first take out your home equity loan, you can choose to borrow against it right away. You can wait, have it sit there, pay the month or annual fee. Most of the time there is an annual fee. This allows you to borrow and pay back as you need to. So one of the key differences in home equity loans is that they disperse a lump. A home equity line of credit, you can choose when you want to use that money. So if you think it's going to be something in the future that you're going to have to pay for, or if you have a need within a month and you want to just pay it off, because you know you're going to have money coming in from another source, bonus, or like whatever the case may be. Tuition expenses for children that are in college, debt consolidation again, or starting a business, purchasing some land, investing in real estate. Yeah, this product can be used for unpredictable things too, like if you want to have an emergency line for your family in case you need it. You don't have to draw from it right away unless you needed it. So do that. Sometimes they get incentivized for that too, but just be careful with borrowing against the home, as it does reduce your equity and cushion. Your cushion can become reduced, so that can limit financial flexibility, and if you use it all and you're stretched and you can't really, there's no more. So you gotta be careful. Lenders can reduce or freeze your credit line if they do see a change in your home value or your financial situation. So these are a little bit riskier. The typical fees that are included with these are going to be your origination, your annual fee, penalty fee. So just be careful. And also with your home equity loan, you kind of want to ask about the prepayment one too. But my advice is just borrow what you need, keep an eye on your interest rate, and have a repayment plan that in place right away, because that's going to be number one, that repayment plan. Variable rates can lower or raise the monthly payment on a month-to-month basis. So if rates go up sky high, your payment can go up sky high. So with home equity lines, you can also have different terms, 5, 10 years. There's usually a draw period. So this draw period is when you can actually access your money. So say if it's 10 years, okay, so I have 10 years to use this money. But say I use 25,000 of the 100,000 in 10 years. That's whatever works for you. Those, you just have to be really financially sound to remember to do that and do those requests. Let's see. So the principal repayment, like I said, it's going to come due at some point in time. Usually it's at the end of your draw period. So be careful and look at your terms. This can significantly increase your payments. So basically, they will make you pay it. If you don't choose to refinance or if you don't choose to pay it off, they're going to make you repay it on a fixed term. So it could be 10 or 20 years after, but your payments will go up typically because you're paying now the principal and the interest versus what you were used to paying. That's just the interest. So you have to be careful because this can impact your monthly budget too. And I've seen bad situations with these at times, so very, very cautious with these products. But usually I find when financial situations do change or clients know their terms will be changing, they do seek out some type of action, whether meeting a financial person at the bank or something. The refinance might make more sense, or just a refi of the home equity, whatever works. Also too, you can also make extra payments too. So if you're looking to kind of pay things off, look at your budget now, see if you can still maintain that budget and stick with it, but refinance to where it makes sense for you. And your mortgage broker, the loan officer should go over all those options with you, just so that way you can see all different things that are possible. But I've had clients come to me for refinance when their draw period would kick in typically. That's usually what I came across. Like I said, let's see, some similarities. So they're both second lien positions on the home equity lines and loans. Upfront costs may be similar as well. Closing costs as well. Appraisal, if need to be, you may have to pay for appraisal too. There's title work that usually will need to get sent over associated with the transaction. Some things you can do and consider and ask yourself too is it going to make financial sense if I take a lump sum and maybe I don't use it all? Because you can always take a lump sum and put that back to the principal too, and now it won't pay off the loan or won't lower the monthly payment. You'll just know that you have most of it paid down and your payoffs will be quicker. You can think to yourself, how solid is my plan to pay off, depending upon like a bonus that's expected, maybe a profit sharing payout, or you'll be getting like a settlement, some kind of big chunk of money is coming in, inheritance. So just kind of think about that. Think about what you have coming up with your, if you have kids, things, expenses that, or even yourself, you have personal goals that you want to achieve and how you're going to be able to meet those goals. Job situations, you want to kind of consider all those things. And then what if I don't receive the money to pay the loan as expected? So like, say if you're expecting that bonus, but like something happened in the company and they were like, oh, we can only do this instead of this. Do you have a plan in place for paying it off into a home equity or refi, and take your time on that decision? So yeah, and with a line of credit, you want to be very disciplined. So am I going to use this line of credit wisely, or is this going to lead to me wanting to spend? Oh, it is not. The limit is a limit. It's not a goal, okay? So you want to make sure that you're making that sound decision and just being financially comfortable and smart about what you're doing with your money. Consider, is this a need or is this a want? And yeah, there are other options, like I said, refinancing your home, doing a personal loan. So you have those options that are available to you too as well. But